Hey guys, Corey here, and welcome back. We're talking about NIO yet again, and this is a video that I wanted to make because of some of the comments I've seen on previous videos regarding NIO. There are so many investors like me that have thousands upon thousands of shares on NIO. There's been comments that people have 20,000 shares at $10, others have 5,000 shares at $9. That is a pretty big loss. So I figured it'd be a perfect opportunity to make a video on how to hedge your position holding NIO, make back some of your losses, and profit from the consolidation or the downtrend of NIO. So how can you do that? How can you profit from a stock that's consolidating or going down? And most importantly, how can you make back some of the losses you've already incurred on a stock? And how can you protect yourself from further losses? Well, I'm going to talk about these three things in the video today, so stick around because I'm going to show you how you can hedge further loss, make back some of the money that you've lost, as well as continue to make money even if the stock consolidates or goes down. So a lot of you are in NIO, and right now, if you have shares of NIO and you are down as a shareholder and an investor, you can be down on a stock if you just buy it and hold it and the stock price consolidates and slowly goes down, or it drops drastically. You can lose lots of money, but I'm going to show you how you can solve this problem and prevent further losses. And these are some of my favorite strategies, and I'm going to show you exactly what I'm doing on NIO and how you guys can implement it into your strategies. Okay, so looking over at NIO, you guys can see the price has gone down significantly. And we've been to this in previous videos. NIO has $8.1 billion in cash. They're $2.178 billion in net cash flow positive, which is huge. They got power swap technology, the NIO power swap, being able to swap in the batteries in 3 minutes or less. And their infrastructure is huge. NIO is selling a lot of vehicles and they have a lot of cash flow and a lot of good things, but they're being held down because they can't get their vehicles in the western side of the world, Canada or the United States. And that's hurting them, as well as the sector sentiment and some other issues going on. But most of it is sector and legislation over here, as they're doing much better than most EV startups in America. They're doing better than any of the EVs in the States other than Rivian or Tesla. They're better than Lucid, Fisker, Workhorse, Canoo, Lordstown Motors. They're doing better than all of them. I spoke to someone in the comments on one of my other videos, and this gentleman was saying he had 5,000 shares. That's a lot. That is 50 contracts you could be selling on covered calls. So I explained this to him. If you sell $4.50 calls on NIO, 50 contracts, which is 100 shares each, 5,000 shares, you can collect $350 per week, which is $1,400 per month. It only takes a couple of months of that to offset any loss that you may incur. This gentleman has 5,000 shares at $5.09. This is a grand total of $25,450. Based on NIO's price of $4.30, that is $21,500 right now. That means that this gentleman is out $3,950. If we divide the $350 that we're making every week on the covered calls, which we can roll out and up if NIO goes up, we can follow the trend, is $1,400 a month. It will only take 2.5 months to recoup all of those losses. So for this gentleman, if NIO stays roughly the same price right now for the next 2 to 3 months, he can make all his money back selling covered calls. Let's look at the calculator. He purchased 5,000 shares at $5.09, $25,450. And then we have 5,000 shares times $4.30. There we go, $21,500 minus $25,450. $3,950 is how much he's in the hole. Now remember that number, because for every call contract you sell is $7 credit, and each contract has 100 shares. So with 5,000 shares divided by 100 shares per contract gives you 50 contracts. Times 7 is $350 per week. We go ahead and we divide $3,950 that he has lost in the last couple of months, divided by $350. It will only take 11 weeks to make back all of the money he's lost. Give or take a few weeks if he has to roll out and up or roll out and down, whatever the case may be. As long as NIO doesn't drop drastically and it stays around $4, it'll take about 3 months to make all of his money back. This is what I recommend you guys to do. Right now, step one, start hedging your position by making back some of your losses. If you've lost more than that, I'm going to show you guys exactly what you can make in a year. So for every 100 shares, you make $7 a week. So if you were like him and had 5,000 shares, that would net you $350 a week times 4 weeks, $1,400 a month times 10 months, 14,000 plus 2,800, 16,800. So if you have 5,000 shares, as an example, you could generate $16,800 a year selling covered calls. If NIO goes down, you roll your covered call out and down. This way you make more money. So you're making money as the stock is going down. So let's say that NIO goes to $2. It goes to $2 in the next 6 months. That's a $2.30 drop. So 230 times 5,000. This man would lose 11,500. But over the next 6 months, he would make $1,400 a month times 6 months is $8,400. So $8,400 he could make back. And he lost $11,500. Take away $8,400. So in reality, even if NIO was to be cut in half right now and go down to $2, at 5,000 shares, that's over $11,000 in loss, but you can make up $8,400 of that in the next 6 months. You'd be in the positive if NIO consolidated for 6 more months after that, because the amount of call premium would put you way in the positive. So you can see how this is great. This will hedge your risk for the future. So on those 5,000 shares, $21,500 in today's current value, by selling these covered calls, this man will be able to generate 7% return monthly. 7% times 12 months is 84%. So 84% of the value of his shares right now he can make back. So if he plays his cards right, he won't lose very much money this year. And that's how you could do it with your stocks right now. You can see the average going from February to March was 5%, but March to April was 10%, which is about an average of 7% per month. So if you're selling covered calls at 7% per month, so you're pretty much on average over the next coming months going to break even if NIO is going down. This is a great strategy. Now, moving on to the next section, if NIO is not going down and it's consolidating, then you're going to be making money on that return. Even if you bought in when the stock was $10 and you're down 50%, it's only going to take about a year of selling covered calls to make a big chunk of that money back. If you're not already doing it, I would suggest doing that. So let's say you bought 5,000 shares of NIO at $10, $50,000. It's only worth $21,500 right now. But with 5,000 shares, you can sell 50 call contracts per week. 50 times 7 is 350 times 4 is 1,400. 1,400 times 12 is 16,800 plus 21,500 is 38,300 minus the 50,000 you originally spent. You're only out $11,000. So even if you bought NIO at $10 a share and bought 5,000 shares, it's only going to take you about 18 months selling covered calls to make all of your losses completely back. This is how you mitigate risk on your shares. You don't just ever want to buy shares outright and hold them and do nothing. You want to sell puts to get in, then you want to sell covered calls to get out or to hold to make extra premium and to lock in profits so you're not losing money when the market goes down. The last but not least is the most advanced strategy, and it's what I like to call insurance on your stock. You carry health insurance, right? You carry auto insurance on your car or your bike because if something happens, you want to be able to cover your losses, right? If you total your car, your insurance covers it. They cut you a check or you get to buy a new vehicle or they repair it. If you're thinking, I don't want to pay a premium to insure my shares, well then why are you paying a premium to insure your house, your mortgage, your cars, or yourself with your health? Makes sense, right? You want to insure the value of the things that you own and not just physical things, financial assets like shares. In order to do this, I'm going to show you a strategy to ensure that your shares don't lose value. This is specifically powerful strategy is best used during an earnings call where you think that the stock that you own could go down. Okay, we're looking at NIO. Let's say we're getting closer to earnings call, or not even an earnings. Let's just say you think NIO is going to go down and you want an insurance policy. You're going to click on buy, click on put. We're not selling puts to get in this time. We're going to buy a put because as a buyer of a put, it gives you the right to sell your shares at the strike price you choose. So we're going to go out to April 2025. If you're watching this in the future, try to roll out 1 year. We want 1 year of insurance on NIO. Every 100 shares, we're going to pay a premium to protect our shares of loss. So what we're going to do, NIO right now is at $4.30. We're going to want to buy an insurance policy on NIO at $4, which right now is between 87 cents and $1.19. We're going to click buy here. We probably could get filled right around $100. This $100 means that for 100 shares, if NIO goes to $1, we have the right to exercise and sell our shares at $4. Yes, you could be wasting that $100 over the course of a year. So if NIO goes up, you're going to make more on the stock going up than you are losing on this premium because it's only $100 for the 100 shares, $1 per share. So if NIO goes to $5.30, that completely offsets the complete cost of your put. But why this is so powerful is that for every dollar that NIO goes down, the money that you're losing on the stock, you're gaining it back on the put, meaning you're really not losing any money at all. And the delta of this right now is 32, but the gamma is 11. So once NIO drops below $4, this delta is going to go to 40 and to 50 real quick. By $3.50, this delta is going to be more or less 60. So keeping it simple, as the price of NIO goes down and you're losing money, you're going to be offset by the gains that you're going to see in the put. So you're going to hold on to this put for several months or a year or until you see NIO going up. Once NIO starts approaching $5 or $5.50 and we have upwards momentum, this put contract is going to decay and be worth probably 50%, $50. At this point, you can sell it, lose that $50, but then that was insurance to make sure you didn't lose any more money on NIO. But you've then made over $100 on NIO because it's went up over $1. So you're only out $50, but that was insurance to make sure you didn't lose any more money. Now, when NIO has an upcoming earnings, I am going to be buying some put contracts. I'm going to be buying 23 put contracts right before earnings. And then when earnings is complete and there's IV crush, I will sell them and recoup some of my losses because it's a small percentage to pay for insurance. So for example, NIO's earnings is coming up in June, so I'll buy June put contracts and I will buy them at $4 and I will buy 23 of them and I'll try to get in around $1.50. So it's going to cost me $3,400 to insure $10,000. Even if NIO was to go up to $6 after earnings, which is probably where it would go if it did well, maybe a little bit less, I would only lose about $800 of this $3,400, maybe $1,000. So worst case, I would lose $1,000 to insure $10,000. You might think, that's a lot of money, $800 to $1,000. Well, maybe so, but that's if things work out with the stock. What happens if NIO goes down? This is where the loss of $1,000 on 23 contracts seems very small by comparison to what you could lose if NIO was to plummet. With those 23 contracts, if NIO was to drop at earnings from $4.30 where it's currently at, let me tell you exactly what that would be. Let me show you better yet. I have 2,300 shares. If NIO was to go down, let's say $2.30, I would lose $5,290. If NIO only went down by $1, we would lose $2,600. You see what I'm saying? On my 2,300 shares, which is just over $10,000 of an investment, if NIO drops $1, I lose $2,650. If it drops $2, I lose over $5,000. However, if I buy the put contracts for $3,400 and NIO goes up or stays the same, I'm only losing about $500 to $1,000. And even if I lost $1,500, it's less than half or a third of the money I would lose if NIO went down. Now remember those numbers, $2,600 to $5,200 is the potential loss if it dropped $1 or $2. So let's go ahead and look at that put contract one more time for $4. With a 32 delta, if NIO was to go up $1, this put contract would go down in value by 30%. So it would go from $150 to about $100. So I would lose about $50 per contract, which would be $1,100. $2,600 if NIO goes down $1 without a put contract. But if we buy the put and NIO goes up $1, we only lose $1,100. So we're only losing about 35% of what we would lose if we didn't buy the puts and NIO went down. However, buying the puts, if NIO goes down, we lose almost nothing. Very, very little. For someone like me who has over $10,000 in shares, I'm risking $1,000 to not lose any more money. I buy the puts, NIO stays the same, I lose virtually nothing, but I've hedged my risk. If I buy the puts and NIO goes down, I lose very little and can sell NIO for $4 and not lose any money at all, really. Or hold the put, even though it's in value and the stock is down, wait for the stock to go back up. The put will go down in value, then I can sell the puts. Pretty close to a break even if possible. So very little loss yet again. So worst case scenario, buying the puts, NIO goes up $1, you lose $1,100. Worst case scenario, you don't buy the puts and NIO goes down $1, you lose almost $3,000 in my specific situation. So you can see that you're paying a premium of insurance, and trust me, it's worth it, because the worst case if you buy the puts is definitely better than the worst case if you don't. And if NIO does nothing, you really don't lose much money at all. And then, like I said, if NIO goes down, you can hold the put till NIO goes back up. And since it's a long leap put 1 year out, you won't really lose much money. Once NIO goes back to the price it was when you bought the put, you can sell it for a very minimal loss and just keep selling covered calls to make up all of those losses, if any at all. So between that strategy and then continuing to sell the covered calls, it's going to pay for the insurance. For me, my 23 contracts would net me $161 a week in covered calls times 4 weeks, $644 a month. I can make back my put loss of insurance in 2 months. So in 2 months, I can make back the money I used to cover any potential losses and hedge my portfolio in case NIO goes down during an earnings or some type of weird catalyst or news event. And the good thing is you can hold a put contract just like this while you're selling covered calls. Price of the stock goes down, your put value offsets the loss from the stock, and you can continue to sell covered calls. It's very good insurance to have in your portfolio. Well, I'm hoping you guys learned something today in today's video. Thank you so much for being here. Be sure to subscribe and tap that bell. This way you guys know when I post new videos. And of course, give me a thumbs up as it greatly helps the channel. Thank you so much for being here. I will see you guys on the next upload. And remember, until then, let's grow our wealth together. Take care, guys.